We've seen the headlines and heard the predictions. Property prices are set to free fall, but what's really going on? Today, we have Jeremy Shepherd, who's Director of Select Residential Property and founder of DSR Data. Jeremy, welcome to the show.
Thanks for having me on.
Now, we see these economists predicting that the market's going to free fall. What's really going on?
Well, I think broadly speaking, the market, that's probably true. I mean, certainly we've seen property prices come back a significant way, but whether it affects every investor or not, I mean, they're not examining the specific markets that investors might be looking to purchase in or already own in. So I'm sure there are some shocking stories, particularly at the high end. It's always the high end that suffers the most when there's a correction. They're the most volatile markets. But there's an enormous number of markets all around Australia that are at the cheaper end, and they don't know what the fuss is all about because they're still seeing price growth.
And I guess that brings us to why you should be looking at average long-term growth in the long run.
Yeah. I mean, these market corrections, I mean, I've looked at data over the last 30 years, and we've only had, well, this is, I think, the fifth correction in 30 years. And in some of those cases, the cheaper end of the market hasn't even gone backwards. But if you do look at the broader market, this is the fifth occasion where prices have gone backwards, and it's usually quite short term. It's not like as long as 3 years, but you'll have booms that last for 3 years. I mean, Sydney had a boom most recently, well, not even recently, the one before that, 2012, 2017, so a good 5 years. So if history has anything to say about this, it'll be quite short term. And like you point out, over the long term, it's just phenomenal how much prices have gone up. So if you do have that long-term focus, there's nothing really much to worry about. People need a roof over their heads at night, and that's always going to be the case.
So what you're saying is that the boom phase, goes for a much longer period than the correction phase. So this could be something that could go for 12, 18 months, do you think, or what, based on history?
Yeah, well, but based on history, 12 to 18 months is probably a good estimate. There will be isolated markets around the country you can find in history that have been depressed for a decade. There are loads of ghost towns, mining towns, for example, during the gold boom or post-gold boom. So, yeah, there are problem markets, but the broader market in general has not historically been depressed for more than a couple of years.
Now, I know in a lot of your research, you talk about above long-term average growth. Now, maybe let's start off with what that is and what it looks like, and then how that actually works and what investors should be looking for.
Yeah, so one of the curious discoveries that I've come to realize over the last decade or so of looking at property markets, over the long term, there seems to be a tendency for all property markets to grow at about the same rate. Now, if you look over 30 years, you will find winners and losers amongst them, but the number of winners and losers tends to narrow the longer you look. So over a short period of time, like 3 years, there could be some tremendous differences in growth rates. 20% capital growth for 3 years versus minus 2% for 3 years. But over 30 years, that is highly unlikely. You just will not see that. That is a ridiculous period of time to have such an outstanding rate of growth or a poor rate of growth. So I like to use the analogy of a fruit shop. Imagine 100 years ago, you walk into a fruit shop and there's a crate of apples and a crate of oranges. And an apple costs, let's say, 1 cent, and an orange costs 2 cents. If oranges grew at 8% per annum over the next 100 years, whilst apples only grew at 4% per annum, then 100 years later, you could buy an apple for 50 cents, and to buy a single orange would cost you $44. Now, imagine walking into a fruit shop and being presented with apples for 50 cents and oranges for $44. There's nobody in their right mind who would buy an orange at that price. And long before that price discrepancy ever arose, people would start looking for cheaper options. They would find, apples look comparatively affordable compared to oranges, so I'm going to buy apples. And that would reduce the demand for oranges, slowing their growth rate. It would increase the demand for apples, accelerating their growth rate. And so you have this balancing out effect. Over the long term, most property markets have this tendency to grow at the same rate. So trying to outperform the long-term average is very difficult. Over the short term, however, it is very easy.
Yeah, that's interesting. So I get that you're saying that, the market's always looking for an arbitrage. So if one suburb is more expensive, then that other suburb will catch up. So I guess how long does that above average high growth in, those high demand, supply demand ratio areas last?
Yeah, well, you point out the algorithm that I created, the demand to supply ratio. What I've noticed is that after about 3 years, most of the imbalance between supply and demand has been sorted out. Now, it can go on for double that period of time. It could sort itself out in as little as 18 months. But the typical period of time seems to be about 3 years.
Excellent. So 3 years. And I guess if you are looking at areas to buy in, what areas should they be?
Well, it's areas where demand is absolutely trumping supply. So tightly held markets where there's very little stock on market. You want to avoid greenfield estates where there may be the potential for oversupply. You generally want to avoid units. Over the long term, it's impossible to guarantee that the risk of oversupply for units will be avoided. They can pop up anywhere. A block of units could be built across the road from your unit or around the corner. You can knock down a block of units and build a bigger block. Whereas if it's houses and the area is already built up, then you are somewhat quarantined from that oversupply. It's vacant land that is your problem for houses. And that, of course, is very easy to avoid. You just jump on Google Maps. I mean, when you go for a drive out to this potential property that you're looking to invest in, you can see where there's a lot of vacant land that could be developed in the future. So my advice to property investors is buy in a built-up area, well away from any vacant land, a well-established area, and buy a house rather than a unit, and preferably an older house rather than a new one.
This concludes part 1 of our 3-part series with Jeremy. Be sure to hit that subscribe button down below so you can keep up to date with when the next video comes out. In the next one, we'll continue where we left off. And as always, thanks for watching.